concepts and strategies to help you keep and grow your money. Now, as you can environment today, I'm actually traveling, speaking to a phenomenal group of entrepreneurs and business owners who want to invest deeper in real estate and who want to benefit from the tax strategies. As we talk today, I thought, what is a great concept to share with you today? And how can I help you grow and scale your business? Are we good? Okay. How can I help you? And so the concept came to me today about how do we help you avoid paying taxes on rental income? Because rental income is the one thing that we're all aspiring to have when we think about how do we get passive income. Typically, we think passive when we think stocks or bonds, crypto, things of that nature could put out dividends, and those dividends could turn into money. But what about passive income like real estate? Now, before we get that deep, I want to remind you of some of the things that I believe inherently. First off, I believe it's your right not to pay taxes. That's my first belief system. I don't believe you should pay taxes. And I believe it's our goal individually to get to the point where we don't. And that's what I call the 3% Club. The 3% Club, by the way, we should get a book. The 3% Club is the elite group of taxpayers who make over $200,000 a year, but pay zero federal income tax. This is the group we want to be part of. And that group has a lot in common. And the commonality is they're always looking to keep and grow their money. And that's my goal, is to help you keep and grow your money. Now, we have to think about three things when we think about keeping and growing. We have to think about three things when we think about this 3% Club. So let me reintroduce the three, what I call pillars of the 3% Club. So first thing I want to start with is we have to have keeping. That is, how do we keep our money from things like taxation? And I call that tax mitigation. Or we could call it tax optimization, how we optimize our tax return in order to avoid paying taxes. That's number one. Okay. Number two, how do we create wealth? Wealth creation, right? We want to create wealth, and we create wealth by putting in the right investment strategies that not only have the right tax benefits, but also will have the benefits of creating our net worth. Okay. Number two. Number three, we're going to talk about the preservation of wealth. How do we preserve our wealth? What does that mean? How do we preserve it? How do we keep it from disappearing? How do we transition that to generations? So let me recap the 3% Club. Number one, the optimization of your taxes. Number two, the creation of wealth. Number three, the preservation of wealth. How do we preserve it? How do we keep that wealth for generations to come? Now, today's episode, we're going to talk primarily about how do we get rental income, which is passive, and how do we take that income in a way such that it doesn't impact our tax return. Because if we have the ability, thank you. If we have, and you haven't gotten a copy of this bad boy, by the way, it was just released yesterday. You could get this, and I'll actually, if we could get the team to comment in the chat, if you could find that link and put it in there, that'd be great. Don't worry, I got you, bro. So how we get there is truly through strategy. See, I believe the number one problem that we face today is not having a plan. See, you can't get anywhere without a roadmap. You can't get anywhere without a destination. Try to get to a location without putting the destination in a GPS. You won't get there. So our goal is to give you that roadmap, that destination. And my goal is to impact you in a way so you could keep and grow your money. And by the way, today, if you have questions, we're going to answer them in the chat. No worries. But here's what I want you to think about. First and foremost, my first thought about real estate. If you own real estate today, you are an investor. Now, determining what type of investor that you are would be very important right now. You could be two types of investors according to the IRS. Number one, you could be an active investor. An active investor is somebody who participates in the ongoing activity of renting their real estate, right? And that is typically your job, your duty is to manage it. You could be a passive investor. That is somebody who puts their money into real estate, maybe not to manage it, maybe not to maintain it, but to get a return. Now, these are the two ways you make money, passive and active. Active could give you some benefits. If you so choose to have those benefits, you get those through what we call strategies. Okay? You could say real estate professional strategy, short-term rental loophole strategy. I'm not going to get into those. You've seen those videos already. But when you're active or passive, that's going to determine how we get taxed on the income from that property. You see, I love real estate, right? And if you followed me for any amount of time, I always talk about the four things that you get from real estate. Number one, you're going to get from real estate by investing, you're going to get appreciation, which means as you buy real estate, the property value is going to increase. That's appreciation. Number two, you're going to get equity. So every time your landlord, and I wish I had my wallet, I'd say gives you a check or a payment or a credit card, whatever that may be, every time you accept a payment, you apply that payment towards your debt. That builds equity, what you owe versus what it's worth. Number three, cash flow, which we're going to talk about today. You got cash flow that comes from your excess of paying off all the liabilities, which is insurance, taxes, maintenance, repairs, and what is remaining from the income that you receive. That is what you call cash flow. And lastly, you get the tax benefits. And it's the most important to me. Now, before I proceed, I want you to know I never buy property with the intention of just getting tax benefits. I always buy with the intention of making money. I always buy with the intention of building wealth. The benefit of taxation or lower taxation comes at the end. That's what I want last. Not because I don't want the taxes. It's just I don't want you to be a dumb investor. Dumb investors buy things without knowing what the consequences of the return. If you can get 5% on your money by putting it into a savings account and you get 3% from real estate, I don't know if that's a smart decision. Now, if it was 5 and 5, I don't know. We had to talk about that. But everybody's challenge is individual. So let's get to the income that you're going to receive. And I don't have a whiteboard here today, so we're going to do some imaginary. I want you to close your eyes and envision it, you know. The goal here is to get you to think about this, okay? So let's say I have a property, and that property is a 3-bedroom, 2-bath home, and I'm getting $2,000 a month for rent. Okay, so I get 2,000, or let's use 1,000. Well, 2,000 wouldn't matter. Let's use 2,000. So I got 2,000, and I got that for 12 months. So that's $24,000 in income. Okay, so I've got a $24,000 income, and you're like, woohoo, cash flow. Well, that's not necessarily cash flow, right? Because we all know that it's not just cash flow. There are expenses associated with this. So what are the normal expenses? Number one, you're going to have insurance. Number two, you're going to have taxes. Number three, you're probably going to pay some interest on the loan. Number four, you're going to have repairs and maintenance. And then you get this real cool bonus kind of expense that comes from the IRS, and it's called depreciation. Depreciation is how a property is deducted as an expense over the course of time. The IRS gives us a schedule to follow. It's typically 27 and a half years for individual property that's single family or multifamily, and 39 years for commercial. That could be storage or any of those things. Okay. We'll assume it's a single family. So we're doing 27 and a half years. So let's do some math together. Okay. So I just said if we got a property and that property was $2,000 a month and I got that at 12 months, that's $24,000. I don't know if they could see that. Can they see that clear? Okay, cool. So I got $24,000. Now, what I want to do is I want to subtract the things that I think are going to be expenses. So let's assume I bought a property and let's say it cost me, I don't know, let's call it $400,000. So I got a $400,000 property. Now, just so you know, for tax savings purposes, the land that I'm on today, does not qualify as a deduction because depreciation is the useful life of an asset. Okay. Depreciation is the useful life of an asset. The useful life of land is infinite, meaning this land will always be here. It doesn't deteriorate. However, the structure of this building will. You know that when you walk into an old hotel, you're like, shit, this thing's old, right? Okay, that's what I mean. So we can never depreciate land. We can't use it as an expense. So I have to subtract the land value of my purchase price because that is not something I can use. So let's assume that the land value is $50,000. So now I have a $350,000 asset. Now I want to take the $350,000 asset and I want to use it on my tax return. Okay. So what I want to do is I want to take 350,000 and I want to divide it by that depreciation schedule of 27.5 years. I don't know why they got 0.5, by the way. Nobody knows. It's stupid. But if I do that, that is a $12,727 deduction. $12,727 deduction. So just to be clear, by owning this property, I already get a $12,000 deduction. Now let's assume now I have other things, right? Let's say my property taxes, because I live in Texas, on this property are, let's say, $5,000. That's about right, by the way. So if I add 5,000 to it, I get 17,000. Okay. Let's say my insurance is, let's call it 4,000 because that's about right today. I'm at 21,000. Now, let's say I have repairs and maintenance. Let's say I have to replace a stove and a water heater, and there's a little plumbing issue. And let's say that's another $5,000. I'm at 26,727. 26,727. Okay. Remember, I was collecting $2,000 a month. So that was 24,000, right? I have $2,700 in a loss. That means on my tax return, I'm going to show that property A made 24,000, but I spent 27,000 almost in expenses, and I have a $2,700 loss. Perfect. I got a loss. So you're like, but David, I want to make money. What the fuck? And I'm like, that's not the point. The point is that you're going to miss is if I go back to my numbers, there was, in this case, right here, this $12,700 loss that I put on my tax return is a made up number that the IRS allowed me to take. It's a made up number. So really, go back. I have 2,700, right? If I add, or in this case, subtract the $12,700, let's just round that up. I actually made $9,000. I'm step back if you need to. I made $9,000 in free cash flow, but the IRS thinks I didn't make any money. This is how you pay no taxes on the income. None. Zero. No taxes on the income that I generated. This is how wealthy people do it. This is how you keep more of your money. This is how you keep your money away from the IRS, from anyone that you don't want to give your money to, but this is the best and most effective way for real estate investing. Now, I teach this strategy in this book, by the way, not a plug. Best-selling author, newest book, just released yesterday. I teach the strategy in this book. I even give examples of exactly what I just said as a tax strategy. I don't want you to pay taxes. I don't want you to overpay in taxes. Let me get that right. I'm very for paying taxes that you legally must pay, but I'm very against paying taxes that you don't necessarily need to pay. And one of the taxes that most people will always pay is on income. But if I don't show any income but technically make income, come on, man, that's how I avoid paying taxes. So many of my clients today are benefiting from this. They're like, David, I want to get into real estate. I want to avoid paying taxes. I want to not pay taxes on the rental income. This is how you do it. Very, very few people will teach you this strategy. And if they do, it's very ineffective because there are other nuances, right? And by the way, this is just on the cash flow. What if I now went deeper, which maybe we can talk about next week, is if I went deeper and I said, okay, well, why don't we show you how to actually take that 12,000 in a deduction? Why don't we turn it into 30,000 or 40,000 in a deduction? And if I could do that with the same property, and I could use that 40,000 now to offset my income from my business or offset my income from other activities like my W-2 income from my job, would that help me? Would a $40,000 deduction be something that you would want, that I'd want? Of course. Keeping more of your money is the goal. To build wealth, you've got to keep more and you've got to invest more. And then you've got to learn how to make sure that that goes on for generations to come, right? It's back to the pillars. Number one, optimizing your tax situation. Number two, creating and generating wealth through your investments. Number three, preservation of that wealth through strategies, structures that keep people from taking it from you, keep the IRS from taking it from you, and allow you to transition that to your children and your children's children and your children's children's children through the process of building wealth. So if you got a lot out of this video, please click on the link above, subscribe, please, to get notified of this live event because every week I come to you live. Now, unfortunately, I'm cutting it short today because I got some things to do, but I am super excited to always share these things with you. My newest book, The 3% Club, just got released yesterday. And I know I want you to get a copy. We're going to put the link in the chat below so you could grab a copy. If you would like to work with me and my team in any way, shape, or form, we'd love to work with you as well. But if we're not a good fit to work together and you love this content, just click the subscribe and share button, please, and get your hands on this free book. Thank you so much, everyone, for watching this week's episode of Building Wealth Live with David. Next week, we will come right back at you live Wednesday, 12 noon CST. If you want to bring your lunch, you want to bring a snack, you want to hang out and chill, I'd love to have you. Thank you so much and have a fantastic rest of your afternoon. Bye-bye.